Hello everyone, welcome to another episode of Bazaar Ki Baat. Today in Bazaar Ki Baat, our guest is Mr. Mayur Patel from 361 Asset. Mayur is the president and manages all the listed equity funds with 361 Asset. Mayur, welcome to Bazaar Ki Baat.
Hi, Surin. Thank you. Thanks for the opportunity.
Our pleasure, Mayur. So, Mayur, before we dive deep into what your thoughts are on the current market situations and the future outlook, if you could just take our viewers through in terms of your investment management journey, experience, and which all schemes you're managing at 361 Asset.
Sure. I started my career around 20 years back after qualifying as a chartered accountant in 2004. My first stint was at Tata Motors Jamshedpur plant in the finance division. Over time, developed a very strong inclination towards equity investing, which led me to pursue the CFA charter and also transition into the equity research roles and later into fund management. Currently, I'm managing the firm's flagship fund, that's 361 Focused Equity Fund, earlier known as IFL Focus Equity Fund, along with 361 Flexi Cap Fund and the equity portfolio of 361 Balanced Hybrid Fund. In terms of investment style, after seeing multiple market cycles across my research and fund management roles, that experience has reinforced the importance of having a blend of value stocks and growth stocks. So at the end of the day, what matters is having a very high conviction at the investment position level,
Sure.
staying process driven. So that's a broad, very crude way of describing my investment style.
Wonderful. So, Mayur, basically, so technically, you're managing all the equity funds with the 361 Asset on the mutual fund side.
Yeah, all the actively managed mutual funds at 361 Asset.
Great, great. That's great. So, Mayur, a lot of action is happening on the geopolitical side, of course. And as we do see that there's a ceasefire announced between Israel and Iran, and there are but a lot of activities, and it's a very, very hot year, if I can define 2025 as, correct? So, do you believe that the markets have actually factored in the entire geopolitical, geoeconomic situations going around us? Uh, do you believe the valuations are in an affordable range? And I'm specifically talking about the SMIDs, the mid and the small side, because that's the broader market and that's heating up a lot. And what should investors do at this point of time if someone, is right at the fence and wanting to invest? So what would you explain that?
So, Suren, let me start off with one slightly different thing from what you asked, but it's very related. The investment profession is quite humbling. It's a never-ending path of learning, adapting, and unlearning. So, one of the most important or valuable lessons which I have learned is do not attempt to predict short-term movements in the markets.
Yeah. So don't predict the unpredictable.
It's an absolutely wasteful exercise.
Right.
No matter how much experience you have in the market or the intelligence, more often than not, the short-term predictions go wrong. Because markets are complex and react to innumerable factors which are just impossible to predict. Now, having said that, and what we can do is, or what we try to do is, to always evaluate the risk reward and take a more directional view, rather than calling out a 10% correction or a 10% bounce over next 3 to 6 months time. Now, if you look at the current valuations, the Sensex price to book is clearly above median. The valuations are on a higher side. If you look at the price to book of Sensex is, it went to 4.25 in September peak, came down to 3.7 in January to March corrections. And again, it has bounced back to 4.2 plus versus the 3.2 median price to book, which we can see over the last 25 years. So valuations are clearly in a zone which is discomforting, especially when there's a lot of uncertainty around US trade policy and also around crude price related risk stemming from Middle East tensions, like you touched upon the conflict which is going on and the ceasefire. Still, things are not clear.
Absolutely.
And crude price is I would say, the most important factor which impacts almost all of our domestic macro parameters, right? So things are uncertain around that. I'm using uncertainty because I don't see a massive risk damaging capital for a prolonged period of time on both these factors. But there are uncertainties, and uncertainties should get baked in to valuations, right? Which is not the case currently. So in the short term, corrections can't be ruled out given valuations and these factors which are quite fluid. But if you look at the domestic factors, there's a positive side. It's the domestic growth story is on a very strong ground. GDP growth is improving, inflation is easing, food production is improving. RBI has front-loaded rate cuts, also proposed CRR cuts. Consumer discretionary, the entire consumption pack was, muted for quite a few years with these 1 lakh crore tax relief and upcoming pay commission related hikes next year. There are enough catalysts for consumption to come back strongly, right? Now, you have these very strong domestic factors which would drive a pickup in growth. So it's very difficult to stay away from such a strong growth story. At the same time, you have these short-term hiccups. So just to conclude on this one, near-term corrections can't be ruled out, but if investors are willing to have appetite for some short-term volatility and invest systematically with a slightly longer-term view, I think there is good value creation which can happen over next 3 to 5 years time.
Sure. And maybe if you could add something more on the broader markets as well, in terms of, because clearly what India has today to offer, it's very different from the last 5 years. And if you go back 10 years, it's completely changed. So what are your thoughts on the broader markets? Because a lot of flows still continue to come into the mid and the small cap side, while, of course, there are valuation worries on that. So what are your thoughts around that as well?
So, as I mentioned, broadly markets are rich and mid caps are trading at even a larger premium as compared to their median. So this is not a market to take really big top-down positioning calls. It's a clearly a market where bottom-up stock selection would matter the most. It could be a large cap idea, or it could be a mid cap or a small cap, depending on the risk reward. I think that's what would drive the upside. There are a few interesting things which can pan out over next few years. So one thing is it's a for markets. So instead of focusing on market timing and calling a correction or a bounce from here, what would be more relevant is to focus on market internals and what's going to drive growth or value creation the most, and which part of the market could underperform and things like that.
Sure.
So there are a few things which I would like to share, like the growth leadership in the Indian equity market could shift from government capex related proxies to consumer discretionary related proxies. Also, on the other side, after outperforming significantly for quite a few years, value can take a backseat, and growth and quality can come back in favor, given the premise of rate cuts, liquidity easing, and consumption coming back.
Sure.
So these are some of the internals which where I'm spending more time rather than market timing.
Sure.
And like you mentioned, what's the structurally, what's the story? India stands out. Clearly, if I were to, in one of the forums, somebody asked me about if you can describe one line to bet on India over next 10 years, what could it be? It's manufacturing. The next
Absolutely.
10-year story is a manufacturing story and still at a very nascent level.
Yeah.
So that's going to scale up in a really big way. And then, you have secular trends and cyclical trends. Like we are currently very bullish on high growth sectors like
Absolutely.
manufacturing, consumer discretionary, power T&D, uh, solar and other renewables, this food delivery come quick commerce, that segment, pharma CDMO, and NBFCs, especially the larger and the stronger ones. Right?
Sure.
But as I mentioned, we always keep a blend of growth stocks and value stocks. So on the value side, the two last sectors which we have are telecom and private banks. So we continue to like these two segments
Sure.
the value side.
Sure. So, of course, absolutely, we are progressing towards becoming the factory of the world, India, and obviously, it's a great opportunity, and we have to just see as to how we are able to capture that the most as the world ecosystem and dynamics are changing very, very rapidly and very fast. So, I'm not leading this conversation towards comparing an index fund with an active fund, but the question comes to my mind is that an investor and understanding that India will be a two-decadal story from here, right? For the long term, I'm not referring to the short term. So, if someone wants to enter specifically in the mid and small, and maybe in the large as well, do you believe an actively managed fund will make more sense, or uh, because or an index fund? Because to my thought is that stock picking will continue to outperform uh, because there are a lot of price discoveries yet to happen in India. So, what are your thoughts on that? An actively managed fund or an index fund? While we are not recommending either, it is just a thought.
Yeah. So I, at the cost of sounding a bit biased, because I am an active fund manager, and I would just uh, look at statistics over last 10, 15, 20 years. I think the active managers have created good value over, over the benchmark. So I think going forward also there would be interesting opportunities emerging in the benchmark, and where based on your research and your process, an active manager can take more active bets, create more value. So technology is something which is kind of disruption, and people who are embracing it and incorporating the tech side into the research process can have an upper hand. But all these taken together, I think still there is a good runway for active managers to create some value or passive.
Great, great. Coming to the near term, any near term, risks which you see in the markets or events which could pop up and probably, do some disruption in the near terms?
So three factors. We need to see the final shape of the US trade policy, because that could drive a lot of things, globally, trade and the overall sentiments also on the equity side. The second is a crude price. It's very important for us. If just crude price is at 120 and it stays there for a year, our entire macro will get a huge hit.
Absolutely.
Obviously, it will reflect in equity valuations also. Crude remains around $60, $70, things remain really pristine.
Absolutely.
So that's very important to monitor. And the geopolitical developments happening in the Middle East. So it's quite fluid, but that's something to monitor. And last but not the least, urban consumption, especially on the discretionary side, has been dead for quite a few years. There are steps being taken in, like the 1 lakh crore tax relief. Next year, we are going to see pay commission related hikes in salaries and wages of government employees. These are very strong catalysts which can drive a pickup in urban consumption, but that's something to monitor. That's important because till now, the key burden was taken by government capex, which grew from 3 lakh crore to 11 lakh crore in 4 to 5 years' time. That's not going to be the growth journey going forward.
Right.
So the consumption has to take the load of driving growth.
Absolutely, absolutely. And of course, the CRR cut of 1%, bringing in almost about a 1.65 lakh crore of excess liquidity should help in terms of driving the urban consumption as well to a large extent. So what are some of the changes, keeping these situations in mind you have made, Mayur, in your portfolios in the short term, what you've done?
All in the portfolio, the investment decisions are all bottom up, but obviously it reflects the thoughts, where we are seeing more risk or more opportunities. So clearly we have shifted weight from the values portfolio to the growth and quality side over last one. So that's one shift. And also, as a matter of risk management, we have shifted some weight over last 6 months, I would say, from the global cyclicals. Anyway, that was a small part of the portfolio, and added more to the domestically driven, stories. Like for increase our weight to manufacturing, to solar, to power T&D, to quick commerce and food delivery, and a few more ideas, few more bottom-up ideas, and funded these by trimming positions in export-oriented auto and auto ancillaries, IT services, and thermal power.
Sure. So if I were to ask you a question, Mayur, in terms of, let's say, 1 year and 1 year and beyond, correct? So 1 year from today and 1 year from hence. So would you be, cautiously optimistic in this 1 year, or would you be very optimistic in this 1 year? And beyond the 1 year, would you be still cautiously optimistic or optimistic? Where would you be in these both buckets, if I were to ask you this?
Sure, if somebody's taking a 1 year view, it has to be a very cautious view. And if extending it to 3 to 4 years, clearly there are many growth drivers. The story looks very strong on the Indian equity side. One of the strongest political regime, which is pro-development manufacturing story, is at the early stage, and cyclically consumption can come back. So there are many levers of value creation if somebody is taking a slightly more than 3 years view, but near-term volatility would be there because of premium valuations and some of these risks. So if you want me to conclude these thoughts into two, just one or two paragraphs. So if you see, global macro is going to be very fluid, and narratives will keep shifting.
Absolutely.
A few months back, there was an oversupply of crude price, and suddenly, it went up by $10 and things like that. So global side is going to be really fluid, but the Indian domestic story looks brilliant, is on a really strong ground. Valuations are at premium, so it's important to keep short-term expectations low, have some appetite for drawdown and volatility in the short term, and invest systematically, taking at least 4 to 5 year view.
Sure.
So historically, we have seen if investors have, taken, instead of a 1 year view, they have changed it to 4 to 5 year time horizon, right? The volatility, as measured by standard deviation in rolling returns, reduces significantly.
Yep.
The risk reward improves.
Yes, that's true. So what would be one message you would like to give through this Bazaar Ki Baat to, all the distribution partners, advisors, and investors listening to you today?
Yeah, that's what I mentioned. Just to conclude in one line is near-term keep. So as capital markets, players, whether it's a fund manager or an advisor, our job is about, apart from the functional role, is about setting right expectations. And as I mentioned, we discussed quite a few points. The message is to have reasonable or slightly more conservative expectations in the short term. And if you keep investing systematically, and every investment you're taking a 4 to 5 year view, your rolling returns would have much lower volatility, because the directional view is very bullish on the Indian economy and also on the Indian equity market.
Sure. So invest in a staggered manner, and then with each investment, sit tight for a 4 to 5 years period at least.
Yeah.
Great. So, well, for our viewers, this is Mr. Mayur Patel, President and Fund Manager, Listed Equity with 361 Asset in Bazaar Ki Baat by Advisor Coach. I think a very, very valuable conversation where Mayur did discuss in terms of the near-term hazards and the long-term opportunities and what he believes of the markets to be coming up. So, Mayur, thank you very much for taking out time and joining us today in Bazaar Ki Baat by Advisor Coach. And hope to
Thanks,
see you
Sohail.
soon
Thanks
again.
for the opportunity.
Thank you. Thank you very much, Mayur.